So given that we had a dropout of a speaker, so I put my efforts into somewhat saying more than I had originally planned. The cost of that is that you don't have the nice, beautiful slides that some other people have, but hopefully a few more insights, I would reckon. I first thought to start out by integrating the financial cycle debate, which is central to this session, into the complex system view, the pedestrian view of an economist. But since many people have, in the first session, have listed the characteristics of complex systems and how the economy in that regard is complex, and what's important is that I will not go through that part in great detail. Just to say that maybe the things that were not as strongly emphasized is that, so we all know that the complex system approach hinge on the interlinkages between the elements of the system. So that is central. So the opposite of interlinkages, independence of the agents. So multiplicity of agents with a multiplicity of interdependencies is crucial for that perspective, and it has been mentioned that nonlinearity can further enhance the complexity. Then the adaptive characteristics of the system, which I would say the changing elements and the changing relationships, and the unstable elements and unstable relationships, including the chaotic dynamics, which has been mentioned, even though I think you can have chaotic dynamics in a very actually reduced system. You don't need many agents and many relationships to generate a chaotic system. So actually, it's not necessarily, the two are not identical in that regard. And then what maybe was emphasized the least so far is the uncertainty about the changes and the relationships. So that's maybe the one thing I want to add. So I would agree with those who say that we in economics have neglected a complexity in the economic system, an obvious complexity that was known and has been studied in the past in history, as was mentioned. And so we have generated workhorse ways of thinking that actually was particularly poor at looking at the direct interactions of the elements of the system, of the economic agents. And I'm personally fully supportive of agent-based models and other approaches to actually rectify for this. We have our own program in the ECB to go in this direction. Although I have to say, my impression is that actually in some of the policy authorities, the speed and determinantness in terms of reforming the tools that are actively used or are considered acceptable for being used in a policy authority actually moves faster and more decisively than actually in the purely academic part of our profession. That is my impression. I don't see in the top schools, and with some few exceptions, I don't see really a paradigm shift happening. I still see this new vision and the other paradigm coexisting, and each one refines within its own silo, and fora like this help to bring us together. But then in the end, I mean, people like Doyne and John Giannakopoulos and others who actually do work across the fields actually are rather exceptional. Even the leading economists, I think the Brunemeyer paper, and some of you may know, and Krishnamurti papers that are kind of leading in this field are not necessarily cooperations between economists and physicists or complex systems people. So there's really a long mile to go. And I think it was also part of the introduction that said that the effectiveness of interdisciplinary work is actually rather small. So we need to go to from these what in economics there was the value in elegance, right? You have to make your point in the most simple and straightforward way with the minimum number of agents and the minimum number of assumptions, and then it is super general from a theoretical perspective. But from a practical perspective, it just goes in the opposite direction of building bottom up a model of the actual behaviors of the elements of the systems of the agents, and we need to go in this direction now. And that is the end of the first part of my discussion. Is that there is, however, not only benefits in doing this, there's also costs in doing this. First of all, in science, the what is called intersubjective verifiability may go down, because as you work more with complex systems where a share of the models that you use are more black box than white box, for example, you may lose some understanding of the mechanisms that actually lead to this, to the effects you are finding. So that's a cost that has to be, it's necessary. I mean, you can't really avoid it as such if you work with more complex models. But in some sense, it has to be actively managed. And it has a side effect on the policy area, is that if you do not have simple intuitions for your results, you have a harder time convincing policymakers. And this, again, has to be managed. If we come with very nice, colorful pictures about how different financial intermediaries in the CDS market interact, and then it leads all to potential dramatic collapse of the whole financial system, then it's not straightforward to explain in a limited amount of time and in great clarity where that result comes from. We may not convince the policymakers that by nature have to be more generalist than the scientists in some sense of doing this. This again has to be actively managed, and it's a real challenge in going down this route, which I personally support as an additional way of approach. First part. The second part, I want to talk about the financial cycle. Then I will come to the discussion of the paper. And last, I want to talk about policy. We were told, we have to talk about policy. So I have to be getting to the end where I want to discuss a bit of policies like Christian did. So financial cycle. So first of all, we have in economics, since the start, a long tradition of looking at the explanations for business cycles. But the way, and it's a central piece of macroeconomics to look at business cycles as the economic cycle. And if you look back in the last decades, you clearly see what I said before, that actually complexity didn't play a very large role in business cycle theory in the proper sense of the word, because there were limited or no interactions between the individual agents in the system. So just to some extent, between some sectors with representative agents, some interactions do take place if there are exogenous shocks. But also this happens in a relatively abstract market where normally the individual agent is assumed to have no weight. Now there's of course a lot of economic research that's not like this in industrial organization, in game theory, and so on. So it's not simply, it did not play a role when we look at some of the key features that make our economies and financial sectors fluctuate. It didn't make its way there in some sense. And it also had its own approach. But that in the business cycle theory didn't play a role, even though we all know how miserable economic forecasts are. I mean, we all struggle with that, the ECB, the OECD, everybody. And still, it didn't lead to this, to making this step. How do we think about in this context on the financial cycle? So now, where did this impetus of complexity come from? So I would say many people were just surprised of the crisis. If you think back in the 2007, we talked about market turmoil. We started not to believe it and think, no, it will go away. And then people learned, and they noticed that the economists and scientists is that the tools they tend to use only to a very limited extent allowed them to understand the crisis. So they had to go more and more granular in that regard. And then naturally, from this more granularity, in order to get back a knowledge of the financial sector, actually it led to this new I would argue revitalization of a bottom-up approach of explaining financial crisis and to understand an aggregate system really from the individual components, rather starting to explain an aggregate system from aggregate components, like what is the paradigm. So this is the reason why we think about, I think, where the complexity perspective came from with regard to financial cycles. And there were two main strands of this. One is the agent-based model network theory. The other is what I said is that the standard general equilibrium models actually are more refined by introducing more and more frictions, more and more heterogeneities, and therefore there's also progress in this regard. And ideally, these two would move in their way and at some point start to intersect, although this is not really so close, it is my impression. So one salient result is the result that has been now mentioned several times, particularly based on BIS work, is that you learn from the present crisis that there are these long financial cycles. And once you think about it, actually you know that there's a history, it was known in the history literature, Kindle, Berger, Minsky. Many people have mentioned these long financial crises. It is rather a historical regularity which seemed to have been forgotten in some sense. Most of this work is empirical, and I want to quickly summarize, starting from what was just said, this work on the long financial cycle. So first there is this empirical work by the BIS that documented that the cycles are longer than the business cycle and they're larger than the business cycle. And actually even make the point, your colleagues, Christian, that actually being pushy, that the financial cycle is a different phenomenon from the business cycle. There was actually a stark statement of the early Draymond, Borio, and other papers. Then there also in further BIS work happened in this field, and there's a work by people like Schularick and Taylor in the top economics journal, in the American Economic Review, which also confirmed that actually credit has predictive power for financial and economic crisis. So that was the point where, say, the standard economic academia couldn't deny any longer that there was an issue and say, no, it just depends on the BIS parameterization. They fix something with the bandwidth and then they get this result, right? So then it was. So now there's actually opened the field to actually explain this fact. So in the ECB we have done some work. What we found, what we add to the discussion, one element that we add to the discussion is that in a paper by Schüler and others last year, that actually the cross-country heterogeneity is very large. So actually in the euro area, there are actually countries, and the stylized fact is still there. But there are still countries, there is actually one big large country where the difference is negligible, and that's Germany. Where actually, Germany is a very peculiar country in this regard, where actually the difference between the financial cycle and the business cycle seems to be, according to estimations, is very limited or is not even there. But then there are others where it's very large. Maybe the average of our estimations is a bit smaller than like double what you had, more or less, comparing the two averages. As second, and that's, I think, particularly interesting, if I go back to the statement about the business cycle being, the financial cycle being a different phenomenon from the business cycle, is that we have a new paper by two colleagues of mine, Gerd Rünster and Marente Vlecke, who actually used so-called unobserved component methods. The peculiarity, multivariate unobserved components methods, I can't explain it in detail, but the peculiarity is that they make actually almost no assumptions on like the frequency at which they look what the relationship between the business cycle and the financial cycle is. And when they do this, actually, they find indeed the financial cycle in an integrated way for 5, 6, 7 important countries is longer, not by as much as the BS estimates suggest, but at the same time, at a medium frequency, the correlation is still large. So we would add to the debate now on the level of stylized facts, not on theory, that actually you can have a distinct financial cycle that's longer or more volatile, but it can still have a significant correlation to the business cycle. Actually, my colleagues estimated that if you go for linear correlation, which in this room may not be very popular, but so if for the moment you accept that, then it is around 0.6, 0.7 correlation coefficient. So it's really material. So what about the theory? That we have run a big research network for 4 years called the Mars Network. I presented it here in the OECD about a year or two ago. And we have developed a number of macroeconomic models in which the credit cycle was modeled. One by Aoki and Nikolov, which comes forth in the Journal of Monetary Economics, and there the explanation of the credit cycles actually are coming from bubbles that the banks hold on their asset side. So that's one way you can go. The other is a paper by Bourset, Collard, and Smets. It's also a theoretical paper with heterogeneous banks in a macroeconomic general equilibrium model. So this is standard economics refined. Okay, so. which comes forth in the Journal of Political Economy. It's another top journal in economics, and there the source of long credit cycles comes from the ampleness of wholesale funding liquidity of the banks, which together with some agency problems for the investing banks, so where they give their credit, their imperfection in granting the credit, leads to these overexpansion and breakdown of credit booms. So in these models also the business cycle is not disconnected from the financial cycle. So I'm still waiting. A very important progress would be for convincing our profession is to now write a structure, what economists call a structural model, that has in one framework, it may be also an agent-based or something, I don't mind, or both better, where actually it comes out from the behavior of the agents that the financial cycle is longer and more volatile than the business cycle in an integrated way. This would be an important project. So then I go quickly to the leverage cycle. So which is more narrowly the leverage cycle, which undoubtedly is a key theory for understanding financial cycles. So what I would like to stress, and I guess that John will do that in the afternoon when he comes online, as well, is what a central result that also undermines economic thinking quite deeply. And remember, Giannakopoulos' leverage cycle, which you would have supposed to have seen already when I speak, but you haven't, so I can't explain it in detail, but it's based on first principles in economics. But one central message is that looking at the interest rate is just not enough. If you want to look at the credit market and the financial system, looking at the interest rate is not enough. You have to look at least, and the source of this is default and the fear of default, is a default risk and expectations or people anticipation of probabilities of default of counterparts. You have to look at the interest rate and you have to look at collateralization or haircut, which is the flip side, or leverage, which again is the flip side again, which is kind of three rather equivalent concept in some sense. So in addition to this, you have to bring in a variable which is the default risk, which is which say could be a credit rating or a FICO score for a household or Schufa assessment or something like that. So and then you will see that you don't have a single interest rate. You have an interest rate that deals with preference for time. But then you have credit risk, that means default risk, and then you have collateralization that manages it. So if you can manage the default risk not only with the interest rate, you actually very often will have a kind of standardized interest rate for a wide class of your borrowers, but you change the credit terms, you change the degree of the loan-to-value ratio, the haircut in derivatives markets and other things. So that's a crucial thing, and it really relies on this notion of default, which you might take a comment also on the paper, which a question I have to the paper, I come to the specific comments in a moment, is that actually default is not really explicitly discussed here, and I think this causes problems for the interpretation of optimality or the wealth. You don't have a welfare function, but like your metric that measures, you have losses of banks. So a deeper way of thinking about the costs and benefits of a regulation is if you have default and then you have the costs of this type of default. That is closer to maybe make it to a more a convincing metric, or like to enrich the metric in some sense. It's a message from the leverage cycle theory that may be usefully. Actually, you say it even at the end of the paper when you say future research. I think you mentioned default risk. I think I've read that. So now then the last remark on the leverage cycle and the financial cycle generally is that this is not the only thing in systemic risk, and also Christoph mentioned that in the introduction. But I want still, normally I have 2 slides or 3 slides to explain that. Let me say, where does systemic risk come from? The financial cycle is a big historical regularity that is very important and has been neglected. Actually, the academic economics profession has focused on contagion very much. But if you look at history, actually the one big regularity is the financial cycle of the BAS type, and this is why people are moving in this direction. Where does this systemic risk come from? It comes from a variety of market imperfections, like how we think in economics. So the market imperfections that play a role in theories of systemic risk is externalities, as you have learned in economics classes, asymmetric or imperfect information. These are the 2 central ones. They play a role in many structural explanations of systemic risk. incomplete markets, you can't insure against certain states of by just trading in markets. The public good characteristic of financial stability. Financial stability is non-rival and non-exclusive, so it's a public good, so that plays a role in systemic, and multiple equilibria. And actually, we have heard about multiple equilibria already today. But this alone is not enough, because that's standard in economics. So the question is, what other features? So one is indeed the balance sheet structures that combine with these imperfections that make the financial system subject to a systemic risk and that make the leverage or the financial cycle so disastrous. So there are three features. So one we have is the center of this session, which is the leverage, is the balance sheet imbalance between asset and liabilities, if you want, debt and equity or debt and assets, which is the leverage. But there are others. There's maturity mismatch. Can also give rise to amplification if you're highly maturity mismatched balance sheet. There's currency mismatch sometimes in some Central Eastern European countries, may also give rise to enormous nonlinearities and amplification. So these balance sheet mismatches are special for the financial sector. The other are the intertemporal nature of financial contracts. So the information problems are so important because financial contracts are about future expectations about future returns. And that actually is again a side comment, an implicit comment on the paper, which also I think Christian made a little bit. There are times when you want to have at least some forward-lookingness of agents. And that's a kind of a quite key part of financial system, that actually it's all about the expectations, what your asset that you have bought returns in the future. And most people will know that the future will not look like a moving average of the past, but even though a share of agents will behave along those lines. And the last is interconnectedness, and you have seen the pictures. This is the third feature of financial system that makes these imperfections so bad. So when we now discuss financial cycles, we should mind that this is only a partial picture of this. The paper by Christoph Doyne and others. So I'm a big supporter of this range of this type of work gaining traction, and for a more interactive approach between economists and people who use these type of models. Now, this is it's not really a typical agent-based model, but it's more of an agent-based model than it is like a general equilibrium model or something. So let me be loose and call it an agent-based model. So it's an agent-based model that has leveraged financial institutions, which is called banks, that are backward-looking or myopic, and they face a fundamental investor that actually invests based on the fundamentals and doesn't have this leveraging target, and is not is looking only at the fundamentals. And this other agent that didn't figure very highly is very important, because in the end the important interactions come from the interaction between this leveraged agent and the fundamentalist fund. So there are two assets, a risky and a riskless one. And one first comment I would have is, if you have two main agents and you have two assets, that's actually something you can solve with some first principles in economics. So you don't need to go to simulation models for that. So it would be nice, probably you can solve it in an equilibrium framework, and it would be really nice to compare. I'm not saying that you have to do this, but that type of setup you can solve. It would be nice to have that. What comes out? So basically, my summary of the result of the paper, when there is a financial subsector that has adaptive expectations, that's a kind of my summary of the paper. A subsector, so it's meant to be a subsector of things, has adaptive expectations, can easily lever up. There is a third agent in the model that gives you to the bank all the credit it needs to lever up. So that's something I will come back to shortly. So it is easy to lever up, and has grown to significant importance of the financial system. That means it holds a larger share in this model of the risky assets relative to the fundamental investor, the fund. That makes it like systemically important, and that's what Christoph calls an macroprudential policy, macroprudential context, when there is this impact, larger impact of the banking sector, of the leveraged investor. So when this is the case, and then its leverage target should be, and that's the main result, kept relatively constant compared to asset risk. So it should not vary either negatively or positively very much with the change in the volatility in the market, and so it should be neither particularly pro-cyclical nor particularly counter-cyclical. So to me that sounds, on the first place, from going backward from the results, that's quite plausible, makes sense to me. And the strong point of the paper, in my view, is this endogeneity and feedback of risk. So that is important. Still, there are some peculiar aspects of the model that I'm not sure how particularly important they are for the results. So first of all, there's this agent that finances any credit that the bank needs to lever up. So, if you have a stress situation, then it becomes difficult to get credit for a bank, for a leveraged investor. So there's some additional dynamics that may play a role. It may reinforce your results, actually. It may not go in the opposite direction. Like Christian, I wondered whether shouldn't there be some precautions against crashes at some point? Like even banks have sometimes not only backward-looking and the last quarter, so there should be crash expectations to some extent, and then some attempt to also insure against crashes. Then the evaluation metric is just the realized losses of the bank, if I understand correctly. So that's it's okay. So first approach, and it makes it very visible, but it's also a very simple way of looking at the optimality criterion of the leverage control policy. And then the last question I have is on the paper is that so you do not dwell very much on the counter-cyclical policy. Now this is the first that that normal people would think about, that the counter-cyclical policy, if you have high risk and there's deleveraging, you have to cushion that. So, and I assume the reason is because in your picture of the different possible situations, you go from the stable case directly to the globally unstable case if you have if you go too much right in terms of. But we really need the intuition to use the model for policy debate. We need to understand the intuition for that one, because most people would think that actually counter-cyclical leverage or counter-cyclical margins would actually be the first order way to deal with this. So what is different here? What is the feature that makes it so undesirable? Also, your picture, the chart you showed, it stops. It stops. The curves start to go down again and stops. So you don't really explain how come that this countercyclical policy is so out of the question, or what makes it then reach the global instability session. I had a few remarks on terminology. I'm glad you took out the word Basel from the title, because it's a Basel. You talk about something that you can't distinguish policy from risk management. So it was really wise. So there are a number of other terms like systemic risk or market power. Yet you may want to fine tune in order to communicate so that like similar to this type of Basel leverage cycle idea that is a very provocative, may make headlines, but in some sense is not really sure one can associate that with this type of regulation. So I'm sorry that the big policy part I can throw in the discussion if you want. So.
Okay. I think we, even though we didn't have a speaker, we sort of seem to have used up all the time. It is so interesting, so I'll let it go on. Maybe you don't have to respond to all of those things, but if you could just, because I think people would like to have a break for a couple of minutes. So if you would like to just take about 2 or 3 minutes to respond, about how you might sort of take into account any comments you've heard that are useful. By the way, I'm sacrificing my.
That's very generous. Thank you. Thank you to the discussions. Thank you, Christian and Philipp. That was very useful. As I said, I'll try to be very quick in order to address these. So I think the first big criticism I heard was I want to hear some more intuition about, on the one hand, why do we see these instabilities in the deterministic case, and on the other hand, why do we see this instability in the countercyclical case? So firstly, I want to say that the deterministic case I would consider as a limiting case of the model. It is not, I would say, the prime, what I would consider the realistic case of the model. But I think still it's an important case, and the intuition behind the instability is that the model as a mathematical object has a fixed point, right? And this fixed point can either be stable, as we have seen. If leverage is low, the fixed point is stable. As we then increase the leverage, what happens to the fixed point? It becomes unstable in certain directions. And the reason why it becomes unstable is that if leverage is allowed to become very, very high, the leverage policy becomes very, very sensitive to very small perturbations in risk. So because leverage policy so the target leverage is effectively inversely proportional to the perceived risk, at some point as risk becomes very small, the sensitivity becomes very, very large. And then in order to approach towards the approach towards this fixed point becomes very unstable, such that you're never actually on the stable trajectory, and at some point you can destabilize and fall off. So I hope that clarifies things a little bit. Now, why are countercyclical leverage policies destabilizing? And so here it's important to say that they are countercyclical with respect to risk, and risk is as a concept it takes in the squared return. So it's asymmetric around price movements. So what happens in the countercyclical case is that if there is a positive shock to prices, what can actually happen? That risk goes up, and then the investor goes in, well, now I'm going to buy some more, and then pushes prices even further up. And what we see is that this is an actually very destabilizing case. Now, I think if you wanted to bring this to the policy discussion properly, one have to also consider the case of a countercyclical policy that keys off not necessarily the risk, but the level of the price, for example. And we've done that in a previous paper where we have looked at, say, a policy that where you increase the leverage, the level of leverage you allow if there is, for example, a downward drop in price, such that if there is a crisis coming where prices start to fall, then you allow the leverage to relax, which is a policy that would not have this problem of symmetry around price movements as the risk-based leverage policy has. Okay, I think I've already talked quite a lot. I just want to say very briefly something about forward-looking expectations, because that came up. So yes, clearly, if you have forward-looking expectations, if you have rational expectations, you can still have a leverage cycle, as John Giannakopoulos has shown, but things look more stable than in our model. And ideally, I think what we would like to do is have some sort of a model where we can interpolate between the case of perfect foresight and the case of sort of naive, backward-looking expectations. And that's something that I think could be very useful for future research. And it's a very good comment, definitely. Thank you very much again.
Okay.